All right, thank you. So next up, we have the Precious Metals panel. So joining me on stage today, we have Robert Crayfourd, co-fund manager at the CQS Natural Resources Growth and Income, Geiger Counter and Golden Prospect Precious Metals Fund at CQS. We have Angelos Damaskos, Chief Executive Officer, Sector Investment Managers Limited. We have Diane Garrett, President and CEO at Hycroft Mining. Torsten Dennin, Founder and CEO at Asset Management Switzerland. And finally, Warwick Grigor, Chairman at Far East Capital. So I'd like to kick things off with just a quick introduction from my panelists. So if you want to just start and give us a quick introduction to yourself and your experience.
Hi, I'm Rob Crayfourd. So as mentioned, I co-manage on 3 resources-focused investment trusts. So one being Golden Prospect, which is a sort of smaller precious metal mining-focused fund, and CQS Natural Resources, which is across mining and energy. But we've got we've got a large weighting, a bit over 40% towards the precious metal sector as well. I'm a geologist by education, been buy side doing this for over 20 years.
Angelos Damaskos, Sector Investment Managers is an independent asset management firm, which I founded in 2004. So we've been going for 20 years, focused on resources, mixed between oil and gas and precious and base metals mining. We invest across the spectrum from private equity to public equities with diversified portfolios as well as concentrated strategies. And I was previously an investment banker, thank you, Diane, but always specialized in natural resources financing. So that's our main focus.
Sorry, I was getting a signal from the back. Hello, everyone. I'm Diane Garrett, President and CEO of Hycroft Mining, where we have one of the world's largest precious metals deposits in Nevada and a recent very nice high-grade silver discovery, but I'm not here to promote Hycroft. Engineer by background and been in the gold business my whole career, so technically I am a gold digger, so that's okay for you to say that. Started out in portfolio management, but really looking forward to this panel with my colleagues here to hear their great insights into what they're seeing in the investment world.
Yeah, my deep respects to all engineers. I'm not just an economist. I'm a CIO of Asset Management Switzerland, Torsten Dennin. We're doing mining and commodity investment for about a bit longer than 20 years. So with mining and commodities like on direct investments. Besides this, I'm teaching finance and commodity at different universities in Europe. Wrote 1 or 2 books on commodities as well.
Yeah, I'm Warwick Grigor. I've been a gold mining analyst since 1982. I was Australia's first specialist gold analyst and basically grew up with a revival of the Australian gold industry. I've done a lot of other things since that time, but my love for gold still exists, and I do it in my sleep.
To kick it off, I thought we could just talk about gold has had a pretty incredible year so far. So, where do you see things going as we move into 2025? Maybe we'll start down at the end.
Well, apart from the last few days, yes, gold was looking good. But I think going back to 1980 when gold ran to $800 an ounce, it's for decades gold was something where people get enthusiastic, it'd go for a run, perform very well, and then spend the next year or two drifting back to where it came from. And that happened again and again. What we've seen in the last 2 years is something very different. It's not dominated, and again, the last week being the exception, it hasn't been dominated by traders, and it hasn't been manipulated the way we used to see. Back in the 80s, you'd always find that the gold price would go for a run after lunch on Fridays in New York. And it was boys having fun, boys behaving badly. And I had that confirmed by the gold desk at Citibank when I put that question to them. And they said, yeah, we just like to stir the pot a bit. Very different more recently. if you look at the buying, the consistent movement of the gold price, the accumulation that's taken place, there's a lot of similarities to stealthy acquisition of shares on a corporate register. It's been dominated by people who actually want gold as opposed to boys just playing around with the gold price. It's been accumulated. You know, you go back 20 or 30 years ago, they'd say gold is a barbarian metal, but it's the central banks that are buying now. There's lots of reasons, but the bottom line is people actually want gold. And I don't see that changing. Just the volatility of the last week, that's an aberration. I expect, we're going to see gold become more and more important as each month goes by.
Yeah, I mean, I guess we should probably address the last week's volatility. I mean, I think it's just important to frame it. Like gold's come back after a stellar period of making gains, and in the last sort of week or so, we've seen it drop 7%. Now, it should also be appreciated that the dollar's also strengthened 4%, so the relative move is not nearly half as material as it appears in any other currency than US dollar. But I mean, if we look at what's driving it, like I kind of view gold as there's a number of cycles within gold and a number of different drivers which sometimes coincide, sometimes they conflict. But what we're seeing here in this more recent move is when we had greater expectations of rate cuts by the market, as when Trump came in, so kind of assumption that he would be more inflationary, there'd be more rate cuts, then you saw a bit of a reversal of trend, and we're seeing that from CTAs, where we've seen fairly high CTA positioning, so through futures. So it's fairly ripe for a bit of reversal. So we've seen that come down about 10%. There is potentially a bit more room for a bit of an unwind on that, but that's more on the paper side. And then physical ETFs as well. So, month to date, we've seen physical ETFs give up nearly the gains that we saw last month. So just to put it in perspective, yes, there's a bit of a blip. I don't think it's like hugely material. And then once that kind of washes out, which is far more kind of spec trader kind of flows, then you kind of then revert back to more of those longer term trends, central bank demand. If Trump comes in and starts to apply more tariffs, we get greater geopolitical uncertainty, then that's only going to really kind of increase the focus from central banks, continue to look to kind of reduce exposure to US treasuries and therefore own gold as a reserve asset.
Yeah, I completely agree with both of my colleagues. I mean, it was just a year ago that gold was at 1950, and then 2 months ago we were at 2600, and then yet we all act like, this is the end of the world the last week with all the volatility we've seen. But it's also very healthy also to have, a bit of a resetting and a breather when you see commodities moving up exponentially like this, and then it starts to re-energize again as people come in. Absolutely, I think we all expected, regardless of the outcome of the elections, there was going to be a little bit of volatility that we would see after that, and we're seeing it. But the expectations of the tariffs, particularly that are being talked about with the Trump administration and providing those inflationary measures, should refuel and re-energize. And the central banks are the ones that are driving the demand right now, and it doesn't seem that there's going to be any signs that will be slowing as they reduce their exposure to the US dollar.
Yeah, it might be like the old Paula Abdul song, right? Like 2 steps forward, 1 step back. Yeah, when you have like this opposite attract, this is maybe the gold silver story on that.
We should do a dance on that up here.
Oh, you don't want to see that. But usually gold and like the precious metal are like leading the commodity space in terms of performance. So you saw like crude oil, copper, like the agricultures were not moving so much up. Of course, this year it's more like a cyclical and the low GDP growth story. Precious metal being driven. And I have like a fun anecdote maybe to share with you, because some weeks ago I was in Zurich at 2 out of the 3 biggest precious metal dealers, where you're selling bars and coins like over the counter, because I'm invited to a wedding and I needed to provide the wedding gift, like small little gold bars for a bride and groom. And I never seen in the last years so many people buying over-the-counter gold and silver like this year. Yeah, I needed to go to a waiting area. I was never experiencing that. Like, oh yeah, welcome. Please take a seat in the waiting area. Take a number. We will serve you when you're ready. I thought I'm in a post office and not at a precious metal dealer. So the last years, I constantly go and buy like an ounce or 2 for my kid with these dealers. It was like, oh, you come in, you go to the counter, oh, you want an ounce of gold, fantastic, here, and you're out in 2 minutes. So totally unexperienced what you see like this kind of behavior like this here. So it becomes a bit mainstream on that side, I have to say.
If I may add a little bit of color for the medium term, because for the last 3 years, gold has been fighting with the $2,000 an ounce level. There were 3 occasions where we breached that level and then scaled back significantly. And we were all scratching our heads with Russia invading Ukraine and wars and geopolitical tensions in China and Taiwan, and nothing was happening with gold. We were expecting it to go much higher, but it wasn't. And it seems like it was fighting the rising interest rate environment, which is negatively correlated to gold. And suddenly this year, since the end of last year rather, gold broke significantly above 2,000 and then started a very, very strong run. Perhaps it was the Middle Eastern tensions adding to the geopolitics, or perhaps the interest rate expectation that changed. People saw the central banks willing to cut interest rates into the future. But interestingly, in the last couple of months, well before the elections and the result with the Trump administration, gold had decoupled from the interest rate because the yield curves has steepened again. And the treasuries, for example, 10-year treasuries now in America are back to 4.5%. Yet gold retains the value around 2,600, which is very important in my view, because it shows that the market structure has changed. There are fundamental buyers coming into the market, and they are in addition to the central banks that have been buying for the last 4 or 5 years now. It seems now that the gold-backed ETFs have turned the corner and they are building again. So there are financial people who are adding to their gold reserves or gold allocations because they want the safe haven aspect. So I think this is very important in terms of the medium-term prospect for gold prices, which I believe will probably stabilize somewhere between 2,500 and 2,700 in the medium term.
Yeah, I totally agree with you that we have seen, all the correlation between US dollar gold and also gold in interest rates collapsing for the past few months. My question is more regarding, the silver and miners. You mentioned that gold did broke out 2,000, 2,100 and then had a fantastic rally for the past few months. And how do you explain that silver is still not doing multiples and that there is so few interest in gold miners, where we could expect the cash flow will be very good in this sector? And I believe that it is still a sector where specialists are there, but the global allocators are not coming back. I also believe they were not the one who were behind the gold rally for the past couple of months. So how do you stand on silver and miners?
Yeah, so a couple of questions in there. I'm sure you all touch on silver. Yeah, so, the miners had been performing well, but to your point, they haven't shown that operating leverage you would anticipate that they should show with the increase in the underlying commodity. And operating leverage is, because you have an operating cost, your margin should increase by much more than the actual physical price because your costs are relatively fixed and therefore your margin increases. If we look historically, one of the reasons sentiment's been so poor towards the miners isn't entirely unjust. If we look at the mining sector overall, particularly in the junior miners, as gold prices gone up, so have their costs, and therefore, margins haven't materially increased. If we look at like post-COVID, we saw a material kick up in the gold price, gold miners rallied, and then they saw cost inflation feed through, which was an issue for everyone and everything and all miners, so not just the gold miners. But then you saw that initial increase in margin then compress back to pretty much the same level as you were pre-COVID. And look, I think people just haven't made the money, haven't made the returns from the miners that they have done from just owning gold over the last 5-10 years. And as a result, I think it's kind of hard to get some of those investors back. So I think sentiment remains pretty poor for the sector. I completely agree with that point. I don't think many generalists are like hugely exposed, and if they are, they just own either one of the larger ETFs or own a couple of the larger guys and are now licking their wounds, having just taken some losses on Newmont or Barrick. I guess the question is, what is different this time? So I think we're in a very different environment. So gold has kicked higher, and we talk about that, breaking the shackles of $2,000 around that March period, and we're now sat at, with a minor pullback at a bit over sort of 2,600. But the difference is that's all feeding through to margin because we're not getting that cost inflation that we saw previously. Actually, in many cases, we're seeing cost deflation in aspects. So the initial bumps in labour inflation, oil inputs like steel's much lower, and general costs. So I'm certainly of the view of the free cash flow profiles for these companies is materially improved, I think it will take a couple of quarters of evidencing that to investors. And if that doesn't materialise, then I think we're looking at a point where we see an increased M&A cycle. I think the larger companies who now have solid balance sheets, more cash flow, will start to acquire as they look to return to adding growth. Or buybacks, dividends. I think we need to kind of continue to see discipline more at the larger scale. I can talk about this for ages, but there's certainly some more points I'd add to that, but I'm sure we can address that a bit later on.
Anyone else want to dip in?
Yeah, maybe on the price part to add to that. Compare silver, the price move to what happened to gold a bit earlier, because gold is an early mover in the industry, and how difficult it was for gold price physically to jump above the 2,000 mark of $2,000, right? When you compare it with this, it was like 4 attempts. The 4th attempt was successful. 3 times it was touching the 2,000, a little bit above, then coming back again. And for silver, this comparable mark is like around the $32 mark. And we this year, silver was really attempting to go over. We were trading at a $35, now coming back in the space of a correction around the 30 to 32. But looking at the long-term price picture, because as an economist, I like to look at like 50, 60, 100 years of prices. You saw that the gold price basically moving up from a physical level, then also inflation adjusted. Inflation adjusted, like the old high for the gold price was around 2,600, I think 60 or 70. And we broke above that this year with this price movement. For silver, because of the speculation, 79.80, you have like these 2 movements to the $50 range. But inflation adjusted, the old price level for silver is like in the 120s. So there's far more space just to break back to this old levels in silver. So you see how silver in the long term, from my view, is depressed in regard to gold. That makes it a great opportunity.
Just getting back to the economics of gold mining today, there are 2 important factors that you have to be considering. Investors have said to me, the gold price has gone up, the grade's gone down, my investment's not making any more money. Why is that? Well, operationally, a lot of these mines, especially the open pit mines, they'll have low-grade stockpiles. Gold mines are always challenged in mine life. And when the gold price kicks up and they can start to treat some of these low-grade stockpiles, they will do that because they can make money out of it now. So there's not a direct correlation with the gold price and what some of these companies earn. The other thing is hedging forward sales. We've had a couple of examples in Australia. One company was sent to the wall because the bank that had provided the finance had forced this company to sell gold forward at about $2,300 an ounce. And when it got up to 4,000 Australian, they basically shut down the operations. There was another company that has got a very good mine, it was going very well, but suddenly they had to go out and raise $150 million because they saw Macquarie Bank knocking on the door and wanting to do whatever the banks do to get hold of the assets. So the other thing about gold, there's nothing generic about a gold deposit. There are similarities, yes, but each geological environment is different. Each operational location has got different aspects. You can look at iron ore or coal very simply. but there's a lot more work required to actually understand the gold geology and the potential earnings. And I think a lot of the investors just don't have the capability of judging that. And there's a dearth of analysts around anyway, let alone good ones. So there's not the sort of depth of knowledge that you might have had 20 years ago in the gold sector.
Well, it's also true that investors have been burned badly in the last 12 years of bear market. And it's widely accepted that in the previous bull run from 2002 to 2012, the most mining companies overextended. They bought assets really badly. They bought marginal assets, they bought them very expensively and geared up their balance sheets. So the sector struggled to restructure the operations during the bear market years of weak gold prices, and investors paid the price. Share prices collapsed. And now generalist investors are very, very cautious. They don't want to get into a sector that they don't understand very well. They can't see the profitability. They can't see the marginal cost of production. And there are many other distractions in the market. There is AI, technology. They can invest in treasuries at 5% very safely. That's the message we hear from generalist investors we speak to all the time. But it's turning around because now the gold price and the silver prices have risen significantly to far outpace the cost inflation. The companies generally, the sector has cleaned up their balance sheets. They are very healthy. They are accumulating cash, at least the mid-cap producers and the large-cap producers. And every quarterly guidance beats estimates. So investors see those, and they are increasingly interested in the sector that is believed to be now very healthy and very undervalued. So I believe it's yet to come, but we have seen it many times before in history when these bull markets pick up, and then investors run over themselves to increase allocations and bid up the prices 10, 15% every day.
Reminds me a little bit of a situation last year when it was here in London at the Mines and Money, and it said it's $2,000 gold, the first time in history. And why do you see also gold mining companies look so depressed? Yeah, it's almost like they're crying.
Yeah. Exactly. Well, and also because for those who are not producers yet, it's a very difficult market because money's coming into the physical metals, but they're not coming into the equities yet, and so it's a tough time. And then what you see, to your point, Angelos, which is, the average investor, has been burned pretty bad in the industry. You've got single asset companies who have stubbed their toe and created issues, and that there's no diversification of assets to, offset some of those issues and risk. But, you also have, a situation where, in the sector today, a lot of the investors are, single assets are very risky. You have a lot of inflationary pressures. Labor is very challenging. And then you have the large companies, which their costs are rising. And so the average investor says, well, if I can't make money on a Newmont or a Barrick or a Kinross very well, then how do I have a chance at a single asset junior company? And then the junior companies have also started to raise money. They've started doing royalties and streams, and they're burdening the balance sheet, which then leaves very little upside left for the average investor.
Well,
which all sounds very negative, but actually it's very positive.
That did sound,
no, but I mean,
sorry for the depressing statement.
I mean, from all of us. I mean, the point is we've got near all-time highs, we've got record free cash flows, and still sentiment's terrible. So actually, there's a big wall of worry to climb against, and actually, I think that's hugely constructive.
So time to accumulate. But to answer your question, you asked the question about the silver relative performance, and in my experience, studying these markets over 20 years, I have seen that I believe that silver typically lags the development of the gold price by anything between 6 and 12 months. And suddenly, for some reason, it catches up and overshoots gold performance significantly. So the interesting indicator is the gold-silver ratio. And we see this ratio being now at around 80 times what you would buy an ounce of silver vis-a-vis an ounce of gold. the 60-year historical average is at around 66. But during that period, that ratio has gone down to 40. So the implied price for silver today is closer to 40, possibly higher than 40, and it could go to 50 or more. So you could take an interesting thesis that I'm sort of 6 months away from a big silver bounce. I might as well accumulate now and buy into undervalued silver as well as equities. And if I'm correct, in 6 months to a year, all of these things are going to re-rate far more than gold.
Do you expect a silver squeeze? I mean, the paper silver market is like 400 times the physical ones. So if the scenario happens,
I might be contrary because I don't really care about the gold-silver ratio. I kind of think it's kind of arbitrary. Maybe there's a technical aspect where some people do and people look at it. Like I kind of focus more on a flow side, but I kind of get to the same conclusion. I think what's super interesting on silver is that it's now over 50% industrial. It's driven by high-end electronics. So we know about EVs, we know wind, we know, but now the big new kicker is like AI data centers. So it's the only metal more conductive than copper. And I'm sure everyone kind of pretty much knows this or has had it repeated to them, but I think it's important to refresh. So I think that's hugely important. The other big driver is that the big polymetallic mines like nickel mines and zinc mines have all been kind of decimated. We're seeing that close across Russia. Silver was a massive product, like sort of byproduct production out of those as well. So this collapse that we're seeing in nickel, given nickel pig iron in Indonesia, is closing nickel mines globally. So that's reducing supply, yet demand starting to increase. We've got to a real critical tipping point. The kind of financial sort of side of it and kind of using it as an offset against gold is just an incremental driver if that really kicks on. But I don't think you even need that for silver to ultimately work. I don't know what the kind of the exact timing of that is and when the market really cares, because there is kind of an excess of kind of nickel inventory above ground that we kind of see getting kind of shipped around, and there's sort of debates around that about sort of Russia selling inventories, etc. But clearly there is a material deficit coming. It's become harder to operate in Mexico and build new mines. There isn't an easy solution to kind of adding that incremental supply.
Silver at Hycroft, Diane.
we have a lot of silver at Hycroft, and it's where are you going to go find large silver projects, right? And we're starting to see consolidation in the silver sector as well. I mean, the fundamentals are very bullish for silver to keep moving. It's not only a precious metal, but an industrial metal and a technology metal. And so whether you're a proponent of electric vehicles or you like your SUV internal combustion engine, you have to have silver for every electrical contact on there. There is no substitute. And the industrial demand that we're seeing and the tailwinds that are being provided by the photovoltaic and solar industry are phenomenal. The amount of solar installations is 3 times higher than what it was predicted to be for the next 5 years. So I think it's just going to take a little time for the physical metal pricing to catch up with that. We're also seeing a lot of silver buying from, the younger population that, a gold coin is gets a little pricey for them. So they're buying silver. And by the way, we were talking a minute ago about waiting in line for your gold coins. I don't know here, but we have Costco, which is a kind of a wholesale. And when they did their silver coins, their gold coins, there were lines. They were sold out in an hour or two. People really want to hold the physical metals of these things. And so I think it's also, when we see the millennials and younger audiences, because we have a big retail younger audience following, and they're very bullish on gold and they're very bullish on silver, but they tend to go to the physical metals and not the equities. And so I think that's a bit of an education of how that leverage and how those margins can play very well for their investment. And it's our duty, I think, to help educate to get to the source of that.
Maybe they are right on the physical side, right? And on the Gen Z and beyond, I see this trend when I'm teaching at university. And there's like investment simulation or investment games. And now for performance reasons, there's investment stories popping up since about a year in gold. Like for years, it was like always like companies, single companies, interesting stories. And gold for the long run, for all of us, is like a preservation of wealth, a storage of value. Like this is the core function of gold, that we have like this year, the last maybe 12 to 18 months, again, like a bull market where gold is running and even performing. Like to have like such a performance that's comparable to equities, even better than equities, giving you such a nice yield is very outstanding. So this is something like I agree with like younger people drives into the precious metal market first on the physical. I see it more on the electronic physical side. So buying, for example, with Robinhood or like Revolut or like where you have like electronic equivalents of physical ounces and not like the precious metal things. Like it's a little bit like old mom and pop stories to go to have like a physical gold coin for them. I mean, what my experience with like my bachelor and master students in their 20s, they're getting it on your phone and you can basically easily flip it against something else when the performance is not right.
That's interesting. And, we were talking about gold decoupling, from the old playbook that it's always been severely. And I wonder if that's a structural paradigm shift that we're going to see going forward in our industry, or could it return to that? And similarly, are we starting to see now the younger audience that is coming in that likes a physical metal, but if they can't trade it or invest in it on their phone or through Robinhood, they're not going into their brokers, they're not calling the desk and the fund managers, right? It's just it's a different way of doing business. And, maybe we need to change some of our thinking as to, how we can take our, corporate presentations and PowerPoint booklets and all of that and turn them into something that is a little more
become more social media
and becoming more social media and connecting. Well,
I hope to see you on TikTok next time. Then.
I have a TikTok channel actually. I will not be doing the Paula Abdul dance unless you join me, of course. Then I'll do that.
Deal.
Okay, let's do it. Will you shake on that? All right.
Okay, enough of global macro. This is a mining conference. And Robert Crayfourd and Angelo Damaskos both told us that the senior miners were making record profits. That means they are building huge amounts of cash. And on the other hand, you have 130 companies here which are selling for unbelievably cheap valuation. So do you think there are 10-baggers in that space, or am I in the wrong sector?
Now, there's definitely 10 baggers out there. I'll talk to you later.
Well, some will go to zero.
The conundrum is why the management teams of the larger and mid-tier producers who are now sitting on record cash are not mobilizing that cash to buy companies that appear to be very undervalued. And in my appreciation and speaking to those management teams, is really they are concerned that if they buy something that is kind of marginal or too early stage, they will not be rewarded by their shareholders. Their shareholders don't yet want them to risk the capital into early stage acquisitions. But I get the feeling that this is changing. The shareholders are now, some companies are sitting on $1 billion of cash. So they think, well, if you are not using that cash, then give it back. What are you doing? So pressure is starting to mount, and there will be some point that management teams will be forced to act. And they need to replenish their growth pipeline. They need to buy more resources. They are likely to buy projects that are with near-term production potential, with sightline to production. And I think that's where the corporate acquisition value lies. If you can find the deposits that will be attractive to the mid-tiers, and I also hear that they might be looking at the so-called bite-sized projects, the projects that will produce 100 to 150,000 ounces per year, not the mega sort of multi-billion-dollar projects. Of course, we saw BHP buy Philo recently, together with the Londons, but that's a different story, I guess.
In Australia, with a lot of the gold companies there's an amazing amount of money can be made from small deposits. People think, well, you've got to be 100,000 ounces production to get on the radar. But if you've got a granted mining lease, and that's very important, the best place to go to find gold is where gold has already been found. If you've got a granted mining lease and you can find a treatment plant to process your ore, the margins on these, what would by institutions be called too small, the amount of cash flow and profits that can be made is quite enormous, and it's astounding when you have a look at it. People are starting to realise that in Australia with some companies, and there's one company that went up 10 times in 3 months when people realised what this company was doing, and there's nothing special about it. It's just right place, right time, right economics. There's more of that coming through the system.
Yeah, I mean, my experience with those sort of sub 100,000 ounce producers in Australia is actually the best ones are stay private. So the ones that end up kind of coming to us on a listed market often have gone through the private funding routes, and there's a number of kind of wealthy guys in Australia that go through those tolling agreements, and I agree there is money to be made. But yeah, I mean, what are the big guys doing? I mean, I definitely agree with that point. They're kind of focused on adding producers. You look at sort of I mean, it's not just gold; it's copper as well. They're very gun shy about going into construction projects. We've gone through that inflationary period, and there's a real concern there about the cost of doing it. The larger companies end up having to gold plate everything; it costs them more to do it. Then there's the sort of local social issues, permitting, other issues. You look at all these sort of copper miners in Peru with like Las Bambas that have had social issues. So they just want that all de-risked to come and buy a producing asset that they kind of fold in. Now, once that isn't easily available, then they start to look down the list, and then it's all kind of price dependent. But at the moment, they can still acquire a producing asset for fairly discounted levels, well sort of below NPV, kind of de-risk that. I think we've also got a bit of an issue where CEOs of larger companies are often on shorter cycles, so it's more like a political cycle and staying there for 10, 20 years and happy to kind of build these projects from early stage and bring them through. So I think they are looking for sort of shorter cycle solutions. I think sort of regionally, I think there's a lot of caution around kind of West Africa and other regions. Mexico's obviously had its issues. It's easier for, say, like a West African producer to buy in West Africa just for a CEO to then go around conferences and have to explain to investors that didn't like a certain asset or a certain region why they're doing that. But I mean, to your point, they are adding cash. I think the initial focus is going to be kind of buybacks, dividends, but they are making cash way kind of beyond that. Newmont's managed to carve out even higher costs out of nowhere and kind of compress that margin. So maybe they aren't going to be as cash generative as they kind of go through this disposal of their assets. But I think I think the disposal of those Newmont assets has actually led a lot of the mid-tiers to hold off kind of making more acquisitive acquisitions because they're waiting to see these assets, where they come out, what level they come at before potentially being more involved in the rest of the sector. I mean, there's some of those assets are coming incredibly cheap. We saw the likes of sort of Greatland Gold managed to buy that share of the Havieron asset in Australia. They managed to buy that for the value of the ore that was already on the ROM pad, which they can basically get a payback of like under a year just from putting that through the mill. So, they are kind of selling some of this stuff pretty attractively. So for companies looking to acquire, I think they want to kind of see those come through, which, through the end of this year, I think it's anticipated that most of those, particularly the North American assets, will have gone through that process. And then that kind of might free the market up a little bit more to see a bit more action. But on the smaller side of things, I think I completely agree with Angelos' point. There is, it has to be of a scale of life. It has to kind of be cleaned up and fairly short route through to production, basically. And that's basically what they're looking for. And they're looking for the juniors to kind of dress it up, put a bow on it before they're kind of interested.
Yeah, I agree with that. And just talking to our corporate counterparts, it's really interesting because you see M&A activity when the markets are very buoyant and very frothy, but when you're in sort of uncertain markets, irrespective of high commodity prices today, the penalties that are being handed down by the investors for an acquisition to spend money on something that doesn't generate cash flow to the bottom line in the next year or 2 years or immediately, they're pretty severe penalties. And what we hear from our corporate counterparts is they want to go after near-term producers, and we've seen a number of acquisitions in the industry recently. And then once they can demonstrate to the market and to their investors that that was an accretive transaction and that those assets are performing well, then they can go down a little deeper and look at the developers and things that they can tuck into their portfolio. It's interesting because we look at where companies are trading. I mean, we're permitted tier 1 jurisdiction trading at less than $8 an ounce. I mean, it's silly. Who would have ever thought that? But it's just it's a sign of those times. It's no different than we've seen in other cycles, where people are focused mostly on production, and then they'll come down to the development stages. And it's a strange psychology because, you pass a store and it's, 50% off suits and you go, well, I don't really need one, but I should pop in because that's a great deal. And then you've got stocks that are 75% discount and everybody's afraid to touch it, right? So it's, but it will turn and it will come back. But the first attraction is really those that can go right to the bottom line. So it's a timing issue for developers and explorers.
My question to you, there's always low equity into the junior mining sector. So what's the main reason there's not that much good quality projects in the junior miner, or there is a very high cost into the junior mining when they do lots of drillings and permittings and it's a long time. But for the last couple of years, junior mining sectors are not really doing good job.
Well, I think the junior mining sector has been starved of capital for many years now because of the bear market, because investors have been sitting on the sidelines, and a lot of the companies have scaled back their plans just to keep the lights going on. And they've been raising little dribs and drabs of private placings to keep the operations just ticking along. So, and I think that could be the reason for the next bull market, because there haven't been any big discoveries. There have been very, very few discoveries because exploration capital has been starved out of the sector for a long time now. So going forward, it's the existing sort of brownfield sites that are attracting attention, and people are working on them to bring them to production and take a benefit of the high prices, the high metal prices. But going into the future, there could be a material shortfall of production.
Just on the juniors having to issue shares just to survive, it's a serious problem we see in the Australian market in that they go to raise money, they do it, the brokers say, well, we'll raise it, it's got to be 20-25% discount to the closing price. And what happens, it attracts not investors, but it attracts people who just want that discount price, and they flip it out straight away. And very poor decision-making and execution of capital raisings for a lot of these junior companies is killing them, because the longer-term shareholders who don't get invited into placements, it's the mates of the brokers and people who can act quickly. They get the cheap stock, they flip it out, and the longer-term supportive investors thinking, why are you destroying the capital of the company? It is a really serious problem, and I don't know the answer to it. But
in the last couple of years, Australia are finding quite good discovery in junior mining sectors.
Yeah, look,
compared to other areas.
There's plenty of gold out there. The other thing that holds back the junior companies and any company is the increasing compliance. All the ESG, everything is slowed down. It's a survival exercise rather than a fast track to production. That's why I said earlier, if you've got a mining license already granted that you can quickly get in and get it out, that's a tremendous advantage. And there are a lot of those around. And the best place to go to find gold is where gold's already found before. It's amazing how much there is there if you really look.
Yeah, I mean, if you come to the fundamental problem, we're kind of right at the spearhead of that, right? So for junior miners, why would we want to put money into junior miners if we don't think we're going to get a return? So it's all kind of chicken egg, because otherwise I would be a terrible steward of my investors' capital if I just continually put money into it on a valuation basis if no one is then going to come and buy it off me at a higher price later. So we've got that fundamental issue. And then if these companies aren't fully funded, then they end up just kind of having to do capital raises to kind of keep the lights on. So, I mean, I'm very heavily, my fund used to be far more weighted towards kind of developers and kind of later stage explorers. I'm currently sat around sort of mid 90% producers. But within that, I actually quite like developers because I think the inflation backdrop has completely shifted. So I think people overly discount developers because those cost inflation risks aren't there in the same way that we've seen previously. But I'm playing that through more having producing companies with development assets, and that kind of allows you to firstly self-fund, and you're not constantly having to come back to the market. So to the juniors that we are invested in, so where do we focus? So stuff that's like proper assets. So on gold side, stuff that is kind of multi-million ounces would attract those larger investors. And where people don't have the capital, and our advice to them is look to try and merge with your neighbours. We need to see more kind of consolidation, so that allows you to get scale. That then allows you to then try and seek further funding. So whether it's ourselves, we aren't the only source of funding, so we kind of encourage them to either go down the corporate route. So we talk to larger miners looking to kind of add assets, and they can't explore very effectively on a cost basis. So we're seeing more of that kind of 9.9 position, which I call the Agnico model. Agnico have done it for decades. So I think we'll see more of that. That also adds support. That's certainly a way of advancing, but I think they need to see that kind of consolidating where we've got assets that might be 4 or 5 million ounces, but held in 4 or 5 companies with management teams that are kind of traveling around and ultimately kind of viewed as lifestylers. There is a way of consolidating those and kind of creating more value and more value for everyone. And then the other option is private equity. We do have some private equity funds out there. If they come in, that then gives us as shareholders more confidence that there's real financial backing behind it to push those projects forward. There's the expertise, there's other aspects we can lean on, and it gives a greater route. And ultimately, the biggest value creator here, so as we're going to the biggest value creator here is shortening the timeline of these projects and getting them into production and de-risking. And that's kind of where we look for, and that's what drives the share price and returns to shareholders and then brings interest back.
Completely agree with consolidation needs to happen in the industry.
Those were some really good insights on the outlook for the industry and where we are right now. So, but thanks also to the audience for your participation and all of our panelists that joined us on stage today.